and certainly we heard from Phil Flynn. Nick Loris back with us, the Heritage Foundation energy economist. Are we good now, Nick? Can you hear us?
Yes, I can.
Okay, great to have you. I can't believe these prices when I'm looking at them, Nick. You?
No, it's not something anyone could have ever predicted with such a dramatic demand-side drop. The International Energy Agency predicts that demand will be down globally 30 million barrels per day than it was a year ago today. And that's not something you can really plan for. Some companies are hedged better than others, but with such a dramatic demand-side drop, even with the global deal of about a $10 million per day production cut, that's still only a marginal impact on prices.
So they would need to cut by more like at least 30 million barrels a day to even attempt to address this, right?
Yeah, to make up for that demand-side loss, that's essentially what you're trying to equate to, which doesn't seem in the realm of possibilities. And with the amount of inventory quickly filling up, especially in the United States, where a lot of the production is landlocked, that's why you're seeing a little bit of disparity between the West Texas intermediate prices and the Brent prices, is that there's a little more storage on tankers and seas right now. But again, that oil has nowhere to go because there's not a real need for any new refining. We don't need refined petroleum products either. And so this glut is very real, and it continues to send prices downward. And without any type of demand-side recovery where people are driving more and traveling more, there's just nowhere for that oil to go.
You know, Nick, we're very close. Apparently, the CME has already green-lighted that this can trade negative. If that's the case, so be it. How does that work? How do we deal with negative energy contract rates? Now, I know this is not in the forward contracts. They're nowhere close to this. But how does that work?
Yeah, again, I think it really boils down to a near-term storage capacity issue where if some of these companies are in a pickle in terms of where to send their products, that's going to be the case. We've seen electricity prices run negative in the past, and that likely could be the case here. Hopefully, if the economy starts to pick up at some point, this will be a very short-term problem. If there is opportunities to slowly reopen areas in regional levels where that we feel confident to adequately protect public health and safety, but at the same time slowly reopen parts of the country, maybe you see demand pick up a little bit more. Maybe you see more resiliency in the oil and gas markets. Obviously, this is going to be a challenge for the months to come, and we're going to see bankruptcies and layoffs and consolidations, as we saw in 2015 and 2016, with consistently low prices. And this is those prices essentially cut in half. So it's going to be economic troubling times for the industry, but at the same time, we've seen them be resilient before, and I'm confident we'll see them be resilient again.
All right, Nick Loris, thank you very much, my friend. A very interesting read on all of this. And